Good evening and welcome to the Economic Bulletin here on Qnews. We bring you the latest top economic stories along with expert analysis on events and trends shaping the region and global economies. Throughout our coverage, we spotlight key sectors and highlight the defining economic developments of the moment. To start with the latest headlines, we'll hand it over to our colleague, Ronald Casals, for the top economic stories. So what do you have for us this evening?
Thank you so much, Shrihem. We have plenty of news and developments from all around the world. And we start off with Europe, where retail sales in the Eurozone rose 1.6% year on year in May, matching market expectations and signaling resilient consumer spending, despite higher prices and tighter financial conditions. On a monthly basis, sales edged up 0.1%, reinforcing signs of steady demand. Markets showed little reaction in the data, with investors now turning with attention to upcoming inflation figures, which could shape the European Central Bank's next interest rate decision later this month. The United Kingdom has introduced stricter rules on political donations, requiring great transparency for large contributions and tighter checks on the source of campaign funding. The government says the measures are aimed at protecting the integrity of the political system by preventing foreign financial influence. The new rules also impose stricter requirements on major donors and company contributions, a move that could affect the flow of private funding into political campaigns. Moreover, the UK's Financial Conduct Authority says artificial intelligence will become a redefining force in financial services by 2030, bringing major opportunities but also significant risks. A new review warns AI could improve efficiency and personalize financial services, while also increasing the threat of fraud, cyber attacks and consumer harm. The report urges regulators, government and the financial industry to strengthen oversight as AI adoption accelerates across the sector.
在这个生产线上，我们能够同时生产10多款以上的不同品类、不同型号。
And moving on to UN Secretary General Antonio Guterres is calling for global rules to govern artificial intelligence, warning that technology is advancing faster than regulators can keep pace. Speaking at the first UN Global Dialogue on AI governance in Geneva, Guterres said AI has the potential to transform economies, reshape labor markets and influence global security, making stronger international oversight essential. Government officials and experts are meeting to discuss ways to reduce AI-related risks while promoting its economic and technological benefits.
That is not sustainable and it is not acceptable. AI is already transformed.
Moving on to Asia, Moody's Ratings has stated fundraising and investment activity in the Asia-Pacific private credit market is expected to slow over the next 12 to 18 months. The agency cites economic uncertainty, geopolitical risks and high interest rates as key factors weighing on investor sentiment. However, Moody's says the demand for alternative financing is expected to remain supported as companies continue seeking funding outside the traditional banking system. China and Finland have agreed to strengthen cooperation in key growth sectors, including the green economy and artificial intelligence, as both countries seek closer economic ties. The commitment came during talks between Finnish President Alexander Stubb and Chinese Foreign Minister Wang Yi, who also pledged greater coordination on global challenges. The discussions highlight both countries' interest in expanding trade and investment cooperation amidst an increasingly uncertain global economic environment. In the Caribbean, Cuba's national electricity grid collapsed at midnight on Monday, leaving around 10 million people across the country without power. The grid operator says it is investigating the cause of the outage. Cuba has been facing prolonged power shortages for months, with frequent blackouts linked to an aging electricity infrastructure and ongoing fuel supply constraints. Moving on to the world of commodities, where oil prices were little changed on Monday, trading around pre-Iran war levels as Saudi Arabia slashed its official selling prices. OPEC Plus approved another production target increase starting in August, and exports through the Strait of Hormuz recovered further. Brent crude futures, which hit a 4-year high above $126 in late April, were trading at $72.19 a barrel, up 7 cents or 0.1%. U.S. West Texas Intermediate crude was at $68.81 a barrel, up 0.2%. There was no settlement for the WTI on Friday as U.S. markets were closed for public holiday. Global markets delivered a mixed performance, with U.S. stocks ending mostly higher, European equities closing lower, and Asian markets posting mixed results as investors weighed economic data and the outlook for interest rates. In the United States, the S&P 500 gained 0.69%, while the Nasdaq climbed 1.29%. The Dow Jones Industrial Average slipped 0.02%. In Europe, Germany's DAX rose 0.15%, while the UK's FTSE 100 fell 0.26%, and France's CAC 40 lost 0.33%. In Asia, Hong Kong's Hang Seng Index advanced 1.14%, while China's Shanghai Composite edged down 0.06%, and Japan's Nikkei 225 eased 0.01%. Those were the economic top stories for the hour. We now return to my dear colleague, Riham Morsi, in the studio. Riham?
Thank you so much, Rana, for those stories there. Now we move to our in-depth analysis. Gold is once again commanding investor attention. Central banks have stepped up their purchases. The World Gold Council sees multiple paths for the market in the second half of the year. And all eyes are now on the Federal Reserve's next move. So can central bank demand keep supporting gold prices? How much is already priced into the market? And what could drive the next major move in bullion? Let's take a closer look. Central banks increased their gold purchases in May, underscoring the metal's continued appeal as a reserve asset despite expectations for higher U.S. interest rates, helping gold trim some of its recent losses. According to the latest data compiled by the World Gold Council from International Monetary Fund and central banks, net official gold reserves rose by around 41 metric tons in May. Buying remained concentrated among leading purchasers, with Poland, China, Uzbekistan and Kazakhstan topping the list. The Polish Central Bank purchased 18 metric tons of gold in May, bringing its total purchases this year to 64 metric tons. Meanwhile, the People's Bank of China added 10 metric tons, its largest monthly increase since December 2024, extending its buying streak to 20 consecutive months. Turning to the outlook, the World Gold Council has stated that gold's performance in the second half of 2026 will hinge on interest rate expectations, geopolitical developments, and investor positioning. Its baseline scenario assumes the Federal Reserve will deliver at least one rate cut before year end, likely in October, alongside monetary easing by the Bank of England, the Bank of Japan, and the European Central Bank. In its gold mid-year outlook for 2026, the Council said gold has had a volatile year, recording more than a dozen record highs and reaching an all-time peak of $5,405 an ounce in late January, before retreating to $4,002 an ounce by June. Gold prices retreated from two-week highs on Monday, pressured by a firmer U.S. dollar though losses were limited as signs of a cooling U.S. labor market eased expectations for Federal Reserve rate hikes. Spot gold was down 0.8% at $4,143.12 an ounce after hitting its highest since June 22nd. U.S. gold futures for August delivery climbed 0.7% to $4,155.50 an ounce. The dollar gained 0.2%, making the yellow metal more expensive for overseas buyers. For further analysis, we're joined from Riyadh by the Chief Investment Officer at Injaz Capital, Paula Tavangar. Thank you for joining us this evening here on Q News.
Hi, Riham. Thank you for having me. It's a pleasure being here with you today.
Pleasure for us too. Let's start off by asking about central banks. They're resuming strong gold buying in May, led by Poland and China. What do you think is driving this renewed appetite for gold despite the expectations of a lower U.S. interest rate later this year?
Now, while there is a trend for a while of central banks buying gold for the past probably 5 years and ramping up the reserves, we definitely had seen some pickup in the last 2 and in the recent months, as you well noted. Maybe if we need to discuss the main drivers or the fundamentals, why generally central banks would pump up their reserves with more gold, the reasons are mainly that gold just performs very well in times of crisis. The other one is obviously gold is a really good inflation hedge. But I think the perhaps most importantly today, the hedge against geopolitical risk is what drives that gold buying. We believe that the central banks are not buying gold based on where it's going to be trading the next month. They're positioning themselves very strategically through asset allocation. So we believe that it's also a diversification instrument to go away a bit from sovereign debt. But what I find particularly interesting here is that the central banks continue to buy despite the record prices of the gold, which tells you even more that it's more about strategical positioning rather than simple price action. And as you mentioned previously, the World Gold Council report, the banks that were surveyed actually said that probably they're expecting more addition to the reserve in the next 12 months.
Well, we've also seen China extending its gold buying streak to 20 consecutive months rather. Do you think this possibly signals a lasting shift when it comes to global reserve management and confidence in the US dollar, or is this a long-term strategy for China here?
Well, of course, when I mentioned geopolitical risks, I meant mainly that it's generally a hedge against tariffs, against sanctions. So what we're seeing, if we look at the breakdown of the countries that the central banks are mostly ramping up the gold reserves, are mostly emerging market countries. So as you mentioned, China is one of them. So I would definitely wouldn't call for this like the end of the dollar, or the dollar still remains the dominant reserve currency. I think it's just a strategical shift that started when the Russia-Ukraine conflict began, and it evolved. Actually, if we look back historically, the ramp up in the gold reserves of central banks started back when Trump stepped back in office. So we highly believe this is very, very strategical for all those emerging market banks.
Okay, well, how important has the official sector demand become in determining gold prices as opposed to the investment flows into gold exchange traded funds and other market participants?
Definitely. I think that there are two different forces in the market here. As I previously mentioned, central banks are here buying for the long-term strategic allocation, and they're way less sensitive to short-term price movements. While we have the institutional investors, also ETFs, retail, which are much more sensitive to what's happening in the market, right? Like any changes in the interest rate, the dollar strength, and just the overall market sentiment. So in the short term, investment flows are still very important to the price action, but I believe central bank buying is creating a stronger base for everybody that's participating in the market, especially with the expectation that central banks would keep on adding gold reserve in the next 12 months.
Well, you mentioned central banks there, which is important because now the World Gold Council expects that the Federal Reserve will cut interest rates before the year's end. How much of the outlook has already been priced into gold, and what happens if the Federal Reserve does not deliver the cuts expected by the markets?
Well, the market these days moves so fast that we're not even talking about cuts anymore. We're talking about potential hikes. So there are a few data points here that can point us towards where the policy is going. I think the new chair, Kevin Warsh, still gave one very small interview at which he didn't give any details on the monetary policy, but he clearly mentioned that he's determined, committed to stick to the 2% inflation goal, which particularly means that if the inflation keeps on going up, there will be hikes. After that interview, I believe the odds of another hike until the end of the year are already priced by analysts. While we are expecting on the next meeting probably for the rates to stay steady. We have another data point that came on Thursday, and that's the jobs added to the economy. The jobs came quite disappointing for the economy, not that much for traders. The report was almost half of what was expected as jobs to be added to the economy, I believe around 55,000 jobs. And this shows that the economy is cooling off, and potentially we're going to see that in inflation as well. As you previously mentioned, the oil prices are also cooling off and coming to levels to pre-US-Iran conflict. So all the data points combined give a bit of a breather for interest hikes. However, there is still one priced, at least one until the end of the year. And this will definitely draw that inflow of cash towards more yield-bearing instruments. It's the opportunity cost, basically, of holding something that doesn't bring you income.
Well, you mentioned earlier in the conversation how geopolitics affects the markets in general, and specifically the World Gold Council cites interest rates due to geopolitical tensions and investor positioning as the key drivers for the second half of the year. Which of these is likely to have the greatest impact or influence when it comes to gold prices? And if so, if you have a certain answer there, why so?
That's a big question.
Yes.
I think on the short term, definitely the interest rates will be the main determinant. Actually, they will drive the price of gold, of stock markets, fixed income, everything, of course. However, the geopolitical risk remains there. There's a lot of uncertainty, and we still have war, sanctions, tariffs, and there's generally growing fragmentation in the global market. So if I need to pick up one, I'll probably say geopolitics.
Okay, well, we've also seen a gold retreat from record highs after a strong rally earlier in the year. Do you view this as a healthy technical correction of the markets, or a sign that the market is reassessing its fundamental outlook when it comes to gold?
Yeah, definitely. I think it's a healthy correction. It's very normal in such a bull market. Gold had already a very strong rally, so the trade became crowded, and there was some profit taking, which is very, very natural. But looking at the fundamentals, what essentially changed? Nothing much. The central banks still are buying gold. There are the geopolitical risks there. There is the potential for Fed hike as well. I think that there is just a major repositioning of the strategy and in the fundamentals of the outlook for gold.
Well, can continued central bank buying provide a floor for gold prices even if investment demand weakens, or will the broader macroeconomic conditions remain the dominant driver here?
I wouldn't say a hard floor. It provides some support for the trend. However, the gold price is mainly the central banks cannot control the price of gold, so it is mainly driven by the retail market and the sentiment. So if real yields rise sharply, then the dollar strengthens, and then the investors will start selling potentially. So it can still correct. However, as I said, the central bank's buying is providing a good basis, at least for a potential bullish market.
Yes, it's a cushion for them, but also the question, bodes itself: what would be needed to change for gold to challenge its record highs that we saw earlier again, and which market indicators should investors look out for to see that this is a possibility in the near future?
100%. On the short term, I would say the main drivers would be any signal of weakness in the US economy, whether that's the labor market or the inflation coming. Inflation coming under control is something positive for the economy. However, it might fuel interest rate hikes, which would impact negatively the price of gold. So if we're looking only at the bullish trend, these are the things that I would definitely focus on. Maybe if we are trying here to predict what's gonna happen, I would say that if we look at the options market is always a really good fundamental to look at where the market's mind is at the moment. And when we look at the options for December expiry, we are seeing the put call ratio at around 0.5, which usually is a quite bullish signal.
Okay, and since you mentioned looking ahead, again, let's look ahead here. Where do you see the gold trading by the end of the year? And what are the biggest upsides and downside risks to your forecasts?
So currently, if we look at the price chart and if we look at the implied volatility that stands around 20 to 25%, we're definitely expecting a 25% move from here. Whether upwards or downwards, I think it will be really highly affected through the interest rates. I know that I kept on repeating myself here, but essentially that's the biggest factor for all the market instruments. And right now we have a bit of a new chair, a bit of uncertainty what exactly is going to happen. So I think that watching very closely the economical data points that will be coming up. Will be very useful in the short term. I would say on the midterm, again, the central banks are providing a really good support through buying gold. So I would expect volatility towards the end of the year. The market sentiment seems slightly bullish, but this can very quickly change with another interest rate decision. On the midterm, quite positive outlook.
Well, thank you so much for your insights there from Riyadh. That was the Chief Investment Officer of Injaz Capital, Paula Tabangar. Thank you for your insights and thank you for joining us this evening. And now we turn to the fan favourite as all eyes remain on the World Cup 2026. 2026 FIFA World Cup is generating billions of pesos in economic activity across Mexico, but new data suggests the tournament's overall impact may be falling short of the government's initial expectations. So let's take a closer look. Mexico's commerce, tourism and services sector has generated an estimated 45 billion pesos, or about 2.6 billion US dollars, during the first 20 days of the 2026 FIFA World Cup. The country's business federation, CONCACAO Servator, says the consumer spending strengthened after a slow start caused by teachers' protests that temporarily disrupted businesses in several areas. Officials say hotels, restaurants, bars, local transportation and tourism services have all benefited from increased demand. The organization is maintaining its full tournament forecast of 65 billion pesos in economic activity, expecting spending to accelerate as the competition reaches its final stages in host cities including Mexico City, Guadalajara and Monterrey. Despite stronger consumer spending, Moody's Local in Mexico says that the 2026 FIFA World Cup is likely to deliver only a modest boost to Mexico's economy. The agency estimates that the 768,000 visitors will travel to the country's 3 host cities during the tournament, far below the government's earlier forecast of 5.5 million. Moody's says Mexico is hosting just 13 of the tournament's 104 matches, limiting its share of tourism spending. The ratings agency expects the event to contribute only 0.13 percentage points to Mexico's economic growth in 2026, providing temporary benefits without significantly improving the country's broader economic outlook. New industry data suggests international travel to Mexico during the 2026 FIFA World Cup has been weaker than expected. According to the International Air Transport Association, air bookings to Mexico City fell 2.2%, while reservations to Guadalajara declined 3.4% compared to last year. IATA says high travel costs, expensive match tickets, and changes in normal business travel patterns have limited visitor demand. The organization also points to concerns over congestion and operational disruptions as possible factors behind the weaker booking numbers. Mexico's vehicle rental industry is also reporting lower than expected demand during the 2026 FIFA World Cup. The Mexican Association of Vehicle Leasing Companies says fleet occupancy reached 63%, well below the industry's target of between 75 and 80%. Industry officials say demand remained relatively stable in Mexico City, but expected increases in popular tourist destinations such as Cancun failed to materialize. The association says the tournament has generated business activity, but the economic benefits have been uneven across the country. To talk to us more about this topic, we're joined from Chicago by the Economic Policy Advisor, Tariq Qadrifai. Thank you, sir, for joining us this evening, and hope you're enjoying the tournament so far.
Yeah, so far so good. It's been a great match.
Yes, it has. It has been very exciting stuff happening. Now, let's start off by asking you here. We've heard mixed reports about the World Cup's economic impact. What's your overall assessment so far of the World Cup in the Americas?
Well, your previous report touched on the highlights of it, really, in that the economic effects from a World Cup are felt, right away in the short term. There's increased consumer spending, particularly on the restaurants and hospitality sectors, but also on local travel. Longer term, though, it's harder to quantify, and this is across the board, and not only just Mexico, but it's hard to quantify long-term effects. But overall, there is increased spending, there is increased tourism, but that is short-lived. So the bigger question for countries is, what is the broader objective of hosting these events? And of course, there are broader objectives, because the amount of spending Mexico has spent on these games, anywhere from $3 billion to $12 billion. And only for hosting 13 matches, as you mentioned, the majority of them over 90 of these matches are being hosted in the United States, which stands to be the biggest beneficiary of the FIFA World Cup this year.
You talked a bit about the big spending that Mexico has done to host the World Cup here. Now, business groups are saying that consumer spending has been strong there, but Moody's Local Mexico paints a much more cautious picture. Why are those assessments so different, and what does this mean for the investments that the Mexican government has done for them?
Well, much of the investment has been on infrastructure. So if you notice, there's mobility and transportation investment has been significant, and of course the stadiums, especially the one in Mexico City, has gone under a $150 million refurbishment. So the question can be, if the FIFA World Cup were not hosted there, would these investments have taken place, or would there have been enough of a motivation for them to take place? That right there is motivation enough for some people to say hosting it is the right move and right decision to make. But of course, on spending being uneven, you mentioned on how travel, especially to some of these cities like Guadalajara, is down this time of year. That could be attributed to several factors, meaning that if they know that the games are being hosted there, travel and domestic travel and domestic business travel would have changed as a result of that, to avoid the perceived extra traffic and extra visitors to those cities. So this is why you hear about the uneven discussion.
Well, yeah, you mentioned there that the Mexican government has expected millions of visitors. The expectations were very high, but that didn't materialize. Why didn't it materialize?
It could be attributed to several factors. One of it, which is the Mexican peso has been getting stronger versus the dollar over the past year. So the appreciation in the peso would have made it more costly, more expensive to maybe some of the visitors, especially from the surrounding countries, to go visit the country. That's one reason. Other reasons could be, the perceived, being very difficult to get to, difficulty finding hospitality and lodging facilities. Mm-hmm. So that right there could turn off people, unless, of course, the marketing campaign was successful in attracting visitors, regardless of, like I said, the appreciation in the peso.
Do you also think that possibly Mexico hosting 13 matches limited the country's economic gains, and this is why people aren't flocking in the millions?
That is one reason, but also, for Mexico as a country, hosting the games is a smart move, because countries, when they do these, there's a broader incentive for them to do so. Obviously, they're looking at the immediate impact. So local businesses, of course, benefit in the short term. However, longer term, they use these types of matches, whether it's Olympics or FIFA games, etc., for long-term marketing, positioning the country, branding. So there's a long-term plan behind the marketing tool of this. And if you look at these games, for example, FIFA in particular, they stand to be the biggest beneficiary from spending because of course, of all the marketing and advertising rights. But after the games, what happens after the game? They hope that the branding and the awareness of the country plays into the long-term travel destinations when visitors start thinking of the next holiday to take.
Well, yeah, I'm sure they're thinking long-term here, but what's interesting is also we saw a decline when it comes to air travel bookings to Mexico City and Guadalajara. It's a bit surprising given that the World Cup is taking place right now. Why do you think that is?
Obviously people's patterns changes. If I know that the games are being hosted in a particular city and I'm not, participating in these games or watching the games, I will avoid my travel until after the games are played. That's just kind of a natural behavior that you'll see, particularly in congested cities such as Mexico City.
Okay, hotels and restaurants have seen also some gains, but many businesses say they're expecting much more. What's behind the expectations by local businesses in Mexico? Why do they hope that there will be better business in the future?
Well, football, without a doubt, is the biggest, most popular sport in Mexico, and being a host for the FIFA World Cup was big news, and it was a big event. And of course, there are always hopes of seeing much more visitors than planned. And I think there is a bit of disconnect between the high hopes that they had versus the reality in terms of what the city and what the country can host in terms of number of visitors, places to stay, etc.
Do you think that also possibly the cost of travel, the high cost for travel, as well as the extremely expensive tickets that everyone has been complaining about, has led to a weaker tourism demand, not just in Mexico, I guess across the Cup itself?
Yeah, I would say part of the reason is that the cost of travel is higher, but also you notice that the Mexican peso has also appreciated. And I think also you have two other countries that are hosting the games. You have Canada and the United States. With the bulk of the games being played in the United States, the consensus or the idea is the visitors who have a limited budget or who were looking to take advantage of the most possible games, they would go to the United States rather than trying to go to all three countries or Mexico versus Canada. It would be go to the United States where you have the chance of being part of the broader games in general.
Okay, well, also there was mention of disruptions from the teachers' protests and the roads being blocked. Do you think this had any sort of impact or lasting impact on business activity during the World Cup?
I doubt it because the popularity of the games, that would be secondary, I think. I think the main concern would be the visitors who want to see the games, they would have gone there regardless of, any type of protest that was happening.
Okay, well, is it fair to say that the World Cup has benefited some sectors more than they have others? And if so, which industries are the biggest winners or losers in this scenario?
The biggest winners would be in the short term, anything travel and tourism related. So of course you have the local transportation, whether it be the mobility transportation or even domestic travel, as well as the hotels and any type of hospitality event. Those would be the biggest winners.
Okay, looking ahead then, could the final stages of the tournament still provide some sort of stronger boost towards the economy?
If you're talking Mexico specifically, I mean, the final game was already played, so there are no more games in this tournament to be played in Mexico. But of course, visitors, the hope is that the visitors will stay for some time after the games, whether it's a few days or maybe a week or a few weeks. So the hope is that once the games are done in Mexico, that there will be some residual tourism that is happening as a result of it.
If we look beyond the World Cup, are there any lasting economic or tourism benefits Mexico could see from hosting these matches? Could we possibly see return tourists or return customers to Mexico because of the investments that they've done in the country?
Yeah, these are two of the most important things. Number one is the increased investment in infrastructure, which will have a long-lasting effect, but also the branding and the marketing campaigns that they've done to bring awareness to Mexico as a travel destination. So I see that as having a big benefit for them, long-lasting beyond this current economic cycle.
If you had to sum it up, has the World Cup met expectations economically, or has it fallen short?
In regards to Mexico, I would say that it has fallen a little short of their expectation, but at the same time, even going into the FIFA World Cup, they already knew that, in terms of economic growth, they're only looking at 0.1% GDP growth as a result of this. So it's a small increase in GDP growth overall.
Thank you so much for your insights from Chicago. That was the Economic Policy Advisor, Tarek Al-Rifai. Thank you for your insights and thank you for joining us this evening. That brings us to the end of our economic bulletin for today. Thank you for watching and stay tuned for more updates here on Q News for the latest from around the world and the world of business, finance, as well as global affairs. And don't forget to follow our coverage during the World Cup, where we will go beyond the action on the pitch to explore the business of the tournament, from sponsorships and investments to tourism, trade and economic impact of the world's biggest sporting event. I'm Rehan Morsi. Thank you for joining us this evening and have a great day.